As I said, there were a lot of little spooks this week. They were a little nervous about things. Are there real risks out there that just happen to go away for the time being, or did we overreact?
David, it's as if investors just woke up and realized that the stock market is a risky place. You see COVID having surged for a while. You see a slowdown in economic growth because of all the shortages we're having. People are now paying more attention to inflation and recognizing that interest rates will eventually have to move higher. And, that has created a bit of volatility. It's volatility that, if we think back, is actually pretty normal. And so, yes, investors got a little bit nervous. We saw some volatility. We've seen, growth, though, continuing to outperform as investors run to some of the bigger cap stocks that appear to have a longer runway of secular growth ahead of them.
So, Steve, what about you? You're a longer-term investor. As you sort through this, which are the false negatives and which are the ones that you're really worried about in the longer term?
Let me start with the ones that I worry about. The thing I worry most about is inflation transmitting itself into higher interest rates, higher interest rates being the enemy of the stock market and of investing in general. And that, to me, is the singular biggest risk. There are plenty of other risks, but I do think for the foreseeable future, we're on a positive growth trajectory. There's still an enormous amount of you can call it excess or surplus or whatever you want to call it, money rattling around in the economy. The government transfers money that people didn't spend last year during the lockdown and so forth. And so I don't think there's any growth issue, but I do think there's a serious inflation interest rate risk out there.
So, JoAnne, let's pick up on that specifically. I talked to Steven Mnuchin, the former Treasury Secretary, this week, and he said he thinks the 10-year is going to 3.5%, in part because he agrees with Steve. He's really concerned about inflation. Is the stock market ready for 3.5% on the 10-year yield?
Well, we've already seen some pullbacks in some of those higher multiple stocks because investors are finally realizing that market interest rates right here are too low. Now, the Fed has made it clear they're going to begin to taper their purchases and they're going to hold away from raising short-term rates. But as they taper, the long-term rates are going to start to rise. And we should expect that to filter into higher multiple stocks. Those are the stocks that are going to see the biggest declines in their multiples. And that's why we advise our clients to make sure, if you're going to own expensive stocks like that, make sure they have very good growth profiles, which a lot of them do. But yeah, it's a risk. I think it's an asymmetric risk across the stock market because not all stocks trade at multiples that are vulnerable to rising interest rates, but some of them really are. And so investors really need to stay away from owning concentrated positions in all those stocks that did so well during the heart of the COVID crisis.
So Steve, the consensus seemed to be, in response to those very disappointing jobs numbers, that in fact it wasn't going to deter the Fed, which seems to be on track to start tapering perhaps November, the next meeting they have. At the same time, if the inflation really is worse than what the Fed is understanding, is there a danger they'll have to really react much more violently when it comes?
Well, first, I think it's risky to try to read too much into any month of jobs numbers. This month had a bunch of abnormalities in it relating to people, teachers and school employees going back to work in September and so on and so forth. The labor force participation number was very disappointing, that people are actually still dropping out of the labor force, not coming back into the labor force. So all of that obviously does push you onto the slower side of the economy. But on the other side, I don't think it's a question of when the Fed decides to taper. I think it's a question of when the bond market decides that inflation is now the bigger concern rather than slower growth. And the Fed is going to end up perhaps in a reactive position rather than in a leading position on that issue.
JoAnne, if that is a risk, taking into account all the other risks as well, what specific stocks do you like at this point?
Well, there are several to choose from depending on what you're trying to accomplish. We try to add a few different elements. Secular growth stocks that can hold up against those inflation increases and interest rate increases. For example, a company like Broadcom. It's into cloud computing. It's helping to supply parts for the iPhone. It has a software side of the business that are really going to keep margins elevated. Plus, it has a really nice dividend yield of around 3-ish%. So that's one where the multiple actually is pretty attractive and offers both, appreciation potential because it's in such really, set of really strong end markets, but it also has a really nice dividend. A lot of our clients really appreciate knowing they're going to get that income in their portfolios over time. At the other end of the spectrum, a consumer stock, like a TJ Maxx, which is really going to benefit as people do get more and more comfortable going out to the actual brick and mortar stores. So those are a couple that we think, bridge the gap between the technology world, the consumer world, and then for some insurance against those rising rates, some of the financials can often play that role as rates go up. as the curve steepens, those banks tend to do better over time.
Steve, if I understood you, you were saying at the beginning you're not so worried about the growth pattern as you are about possible inflation. But talk to me about China. Am I overly focused on Evergrande and the Chinese property market? Because I've seen some remarkable numbers about how much of Chinese growth is dependent upon that property market, and therefore how much of global growth is, because we depended so much on China over recent years.
Well, you're certainly right to worry about Evergrande. The problem with China in general, Evergrande certainly being an example of it, is there's so much opacity in China that it's really hard to know what the facts are, what we should even be worrying about. Mm. I think the Chinese, I think everybody on the planet is aware of the Evergrande problem. I think the Chinese are certainly aware of it. I think they're trying to manage their way through it. I would be cautiously optimistic that they will be able to manage their way through it. They have a lot of tools at their disposal. They don't have to deal with a Congress and so on and so forth. But it is certainly a risk. But let me mention just one other risk quickly, which I meant to mention before, which is the risk to corporate profit margins. So I agree that, as I said, growth is definitely happening out there. But the question is really whether companies are going to continue to be able to pass along the increasing costs of their raw materials and their other supplies. And that is an issue for corporate profits, and then obviously for the stock market after that.
So, JoAnne, why don't you wrap us up on that very point, because we're about to go into earnings season again. Now, what about those profit margins? And it's not just raw materials, it's also employees. We saw in those jobs numbers, the wages are going up.
Yeah, that's exactly right. But what we've seen so far is companies have been able to pass on those costs in the form of higher prices. We're hearing that from the consumer guys as well as the housing builders as well. So, it's certainly a concern going forward. And I do think that this earnings season, we're going to get a mixture of responses on this. With some folks, some companies saying they can pass these cost increases into prices. But more generally, right, these shortages that are driving up these costs are things that are actually going to extend the time period for which that economic recovery will take place. That's actually a positive environment for equities, even though we do have in the background that interest rate increase, right? The longer it takes to recover, right, the longer we have to ease those shortages to really boost sales for companies and boost their profits over time. And that's a pretty good environment for equity investing. And I think a lot of folks are getting distracted by this very misused term, stagflation, that I've been hearing. As an economist, I can tell you, this is not stagflation. We have very solid GDP growth, and we're going to have growth running ahead of long-term norms for it looks like several years to come.